So I spent the last 10 years searching for the perfect strike price for buying options, for selling options, for call options, for put options, and I think I figured it out. So in this video, I'm going to walk you through the exact framework of what strike price I pick based on buying options and selling options, and then calls and puts, of course, too, to how I built this $1.2 million account. Okay, so before we go into the chart to figure out the best strike price to pick based on buying options, selling options, calls and puts and all that stuff, and before we actually go into Robinhood and go into the options chain to show you the huge problem that most retail investors make when they go to pick their strike price, we have to talk about high level, this thing called delta, because so many investors out there say, look, I'm going to buy this option as a delta of this, or I'm going to sell an option and it has a delta of this. That is my theoretical chance that I'm going to make money. Let's think about this really quick. Actually, we'll just go to Triple Q right now, and we have this set up on selling a put option. We're going roughly 1 month out. Current share price of Triple Q is $613 per share. So here's what we're going to do. We're going to say that we're going to sell the $600 put going 1 month out. If we go down here and we click on that right there, we're going to load this up, and you can see this thing called delta right here, bottom left delta. It's 0.32. So theoretically speaking, the typical average Joe retail investor is going to load this up and say, hey, if I sell this put option right here, I theoretically have a 32% chance that this contract is going to expire in the money. So they're just like, oh yeah, 1 in 3 chance it goes into money. That's no problem. I'll just wheel out of the shares or whatever I want to do if I'm selling a put option. But the problem with that is that what is delta? Like, that's what I always ask people that drop comments below. What is delta? Why does delta matter? Oh, well, it's just that's a percent chance it's going to go into money. But let's break down delta a little bit. What does delta actually mean? Delta basically just calculates a few different things and says, what is the implied volatility of that contract? What are interest rates currently at right now? How long is that contract in duration? And which way are you going, on the bullish side or the bearish side? And where do we think the stock's going to go? But think about this. Like, yes, these are 4 important things to factor in for the percent chance a contract's going to go into money. But what is it leaving off? Like, let's just look at NVIDIA, for example, because it's really easy to just, think about this one. What is the revenue doing for NVIDIA? It's not factored in. Earnings per share growth, not factored in. What if AMD is coming on NVIDIA and going to make a better chip for a cheaper price and it's more efficient? Not factored in. What if the hyperscalers are planning to cut back all of their capital expenditures and not buy data center chips? That's not factored in. What if the overall S&P 500 or the NASDAQ is a bubble, and when that market crashes, it's likely to bring NVIDIA down with it? Again, that is not factored in. I could literally go on this list for days and days and days of things that is not factored into the delta. So when people sit there and say, oh yeah, I'm going to go with the delta, I'm going to pick a delta that's 0.32, this doesn't matter because it's not really even factoring in anything that even matters in the options world. This is just saying, hey, based on these 4 things, yeah, you probably have a 32% chance of going into money on that. And that is where most retail investors go wrong. So what we're going to talk about in this video right here is a better way to pick a strike price, a way that doesn't rely on basically just guessing and hoping that, oh yeah, 32% chance it's into money. A way that actually works, a way that works through a bull market, through a bear market, that anybody could do. It's not hard what I do, it's not rocket science, but most people just don't want to do it because they don't like longer duration option contracts. And I'm going to prove to you, and I proved to you in many of my other videos, that longer duration option contracts are not only easier, but they're safer and you could pick a better strike price. Okay, so the best way to make this make sense in a crystal clear way that anybody could understand, we're going to look into Charles Schwab, we'll set everything up in real time, and then we're also going to go back and forth and reference this chart right here. Now, the first thing that we have to do before we actually set it up in Schwab is I just want you to understand one single thing on this chart. I've talked about it in plenty of my other videos, and I'll link a couple good ones at the end of this one too. This line right here corresponds to the earnings per share of the NASDAQ going up and to the right, EPS up and to the right. The stock will follow that in the long term. But short term, yes, there's going to be a lot of volatility. Maybe there's opportunity to buy right here because it's undervalued. Maybe it's a little bit expensive up here and it's time to be very, very careful. So what we're going to do is go back and forth and reference this as we set this up in Charles Schwab. Okay, so you could see that we set up a triple Q put, sell to open, 1 contract. We have a strike price of $600 and an expiration date of 2/6 of 2026, which is roughly 1 month from right now when I'm recording this video. And if you're watching this video a year from now, it doesn't matter. You can see I have level 3 options set up. I have about $1,000 in cash in my account. I have millions of dollars in buying power if I want to use that because I always have my money invested in some way, shape, or form. I have some hedges on the market. I have some bonds, but overall, all my money is working right now. So I'm going to sell a portfolio secured put right now. Not cash secured, portfolio secured, and I'll link a video at the end to help explain that to you if you don't understand it right now. Okay, So as we talked about in the Robinhood example from earlier, we set this exact same contract up. There was roughly a 1 in 3 chance that you're going to expire in the money on this sold put. $613, $600 strike, you get $800. Great, 1 month out. But let's think about this. What if I do this contract for roughly 1 year out from right now? So it's currently the beginning of January of 2026. Let's just go to January of 2027. Here we go, January of 2027. So notice when we go to the 1 year contract that you're picking up $40 per share in premium, way more premium than the other contract when we did just 1 month. So your break even on the longer duration 1 year contract is $560 per share. But if we go back to the 1 month contract, remember we're going to go out to 2/6 of 2026. Take a look at the premium you're picking up there, $8. So when you subtract the $8 from $600, you can see that your break even is roughly $592. Now at first glance, you might not think that's a really big deal, but when we go back and reference this chart right here, notice what the stock market is doing in the long term with regards to the earnings per share growth line. And keep in mind, this is a 5-year chart, by the way. 5 years, NASDAQ earnings per share is going up and to the right, but you can see that the market does a lot of volatility in the meantime throughout that period. But in a 1 month period, if we just take a snapshot anywhere, earnings per share isn't really going up that much. So not only is earnings per share not going up that much, so you don't have that tailwind of growth behind you, but on top of that, you're picking an option contract that has a much higher break-even price than a longer duration contract. Notice your break-even right here again is roughly $592. But if we go out to my contract that goes to 1/15 of 2027, what is my break-even right here? It's roughly $560. So not only am I getting more premium, which is definitely lowering my break-even price, but I have the tailwind of growth behind me. In a 1 year period, earnings per share is likely to go up and to the right of the NASDAQ. Of course, there's periods of time where it's not going to go up and to the right, but most of the time when you do a longer duration contract, you have that tailwind of growth behind you. So when people go out there and say, oh yeah, I'm doing these monthly contracts and I'm doing really, really good, it's like, dude, number one, the last 3 years of the market, it's been literally straight up. So doing any sold put through this period, like you would have did pretty good. Right here, you might have had a little bit of problems. Right here, you might have a little bit of problems. But overall, like the market's been going straight up. And most of those people don't know anything about this period right here where the NASDAQ fell like 35% and took about 2 years just to get even if you would have bought up here. Like think about all those people that were selling short duration option contracts, choosing these strike prices that are almost in the money, and they don't really have a clue of why they're doing it. So when I feel like things are compelling, kind of like down here in this time frame right here and down here in this time frame right here, I am not going to choose a $600 strike price put when the current share price is $613. I don't have enough margin of safety in that trade. And again, from the top, I'm only selling the put option if I feel like the company or the ETF is undervalued with a moat, with pricing power, durable competitive advantage, and all that good stuff. You know about that stuff from my other videos. So when the stock or the ETF passes those tests, I'm willing to sell the put. But again, I want more margin of safety than $13 per share just under the money right there. So what I'm going to do is instead of doing a $600 strike price put, I'm going to go down to roughly a $550 strike price put. So notice how my break even is now way lower than what the monthly contract is, and there's way more margin of safety built into this trade. Roll with me on this really quick. Let's just say we go into bid. Let's just say we pick up $25 per share in premium for easy numbers. Our break even right here is going to be $525 per share. $525 per share, $613 right now, and we think it's cheap at $613 per share. Just for the example, we think it's cheap. So look at how much buffer you have on that trade right there. Almost $100 per share in a buffer. But when you do a 1 month contract, take a look at what happens when you go and try to sell a 1 month put. So we'll go to 2/6 of 2026. Notice how you're literally picking up $1 per share in premium, literally $1. So your break even, we'll just say, is $549 per share, whatever. But if we go out 1 year and we go out to the contract that is the 1/15 of 2027, I am picking up literally almost 26 times what you're picking up in premium. And I get a much lower break even than you, but I also have 1 year on this contract. So again, going back to this chart right here, I know we're going to, you probably want to talk about calls and stuff like that. We'll talk about that in a minute. But just going back to this chart, and it kind of like lays the foundation for calls right now too. With 1 month, you get a crappier strike price with a crappier break even, and you have no tailwind of growth behind you. 1 year, you have the tailwind of growth behind you, you get a better strike price and a better break even. That is the name of the game. That is why selling put options, longer duration is better, but I know this video was about doing strike prices and stuff like that. Doing the longer duration contracts gives you the ability to do a better strike price. Like oftentimes, like when the market was cheap down here, I was selling like 2-year put contracts down here. And I was choosing a strike price that was way below the money. Like if we just go 2 years out from right now and I sell, we'll just say I sell the 550 strike price put, I'm going to pick up $40 per share in premium. My break even is literally $510, more than $100 per share below the money right now. And again, I'm only selling a put when I feel like it's compelling. So I went 2 years out. Let me get myself out of the way. I went 2 years out. Notice what the earnings per share growth line is doing in 2 years. It is clearly and obviously up and to the right. So when you have that bullish tailwind behind you and you have a strike price that is way down here out of the money, it's unlikely that sold put is going to expire in the money. On top of that, when I'm selling the portfolio secured put, I'm only selling it when the company or ETF is undervalued. So I'm generating a lot of cash flow right now, literally like 10 times sometimes what you're going to do like a 1-year contract versus a 1 month. So I'm going to take that cash flow and reinvest it at the time that the market is cheap. But when you're doing your monthly contracts, you're going to get less cash flow. You essentially have to hit 10 trades in a row to make what I made in one single trade. And you're doing trades when it's not compelling. And again, you're not choosing good strike prices because you can't, because there's not a lot of demand for literally going to a 550 strike price put. Like we'll just go out a month again. We'll go to the 2/6 of 2026 right here. Dude, you get $1 in premium. It's not even worth it to sell that put contract. Like, sure, it's unlikely it's going to go into money, but it's not even worth your time. You're going to make $100 and you're going to have an assignment value of $55,000 for that contract, because 1 times 100 times 550 is $55,000. I talk about that again in my other videos. I'm just saying that it's literally not worth it to do this contract unless you do a longer duration contract. Okay, so I want to flip into buying call options and buying options too. We only talked about selling put options right here. We'll talk about buying options and buying call options in particular for how to pick the right strike price, because you could make a lot of money with call options. I kind of correlate it like selling options is like going for a first base hit. Going for buying options is kind of like swinging for a home run. So you can make more money swinging for the home run, but you're more likely to strike out. So selling options is like a first base hit. It's very consistent, much more easier to do if you do it the right way. And now we'll talk about, the harder stuff, which is buying options and how to pick the right strike price for that stuff. So let's dive into that. Okay, so let's flip things around a little bit. We're going to go for triple Q. We're going to go for a call option now, and we're going to do an action of buy to open, because we're going to buy a call option to open the trade. And now everybody wants to know, what strike price do we pick? And you could probably guess from before, it's going to be correlated to the expiration date that we pick. So let's just do what most retail investors do. We're going to go roughly 1 month out. We're going to go with the 2/6 of 2026 contract again. The current share price of triple Q is $613. So here's the thing about it. A lot of people will say, well, Brandon, why don't you buy deep in the money call options and you have way less chance of that contract expiring out of the money? Aren't you going to make more money if you go way deep in the money? Sometimes yes, but sometimes no. And here's the thing about it. It's actually easier to explain this on a chart right here. So let's look at this period right here. It would have taken you literally 2 years if you would have invested up here to get even on your money. Just think about that, 2 years. So when people tell me, well, Brandon, like I'm really bullish this company, instead of spending all this money buying the shares, I'm just going to go buy deep in the money call options. And it's a way that I could get exposure to the company, but not necessarily have to put up all the money to buy the shares. And yes, you are right. If the market's going up, yes, you're going to make more money. But oftentimes the market's not going to go straight up and to the right, like this time frame right here again. And this was only a couple years ago. This is likely to happen right now with the current market valuation level that we're at. Like the market's likely to take a breather. But you spent all that money buying those call options. Like we'll set it up in 1 second. You spent all that money buying call options right here, going 2 years out, and the share price didn't do anything. And you have all that money tied up in something that could expire worthless. Think about that. You bought all that stuff. You put all that money into that trade for something that could literally expire worthless with an expiration date. Or why not just go buy shares right here? And they don't have an expiration date. You could ride those shares literally forever. So let's just set this up in real time together. I didn't go like pre-plan this out to make my numbers make sense. I don't even know what the numbers are going to say, but I know that they're going to fit what I'm trying to get explained right here. Let's take a look at this. If we just go for a 2-year call contract right here, a 2-year leap, and let's just say that we're going to go to, we'll just say a 480 strike price right here, currently $613 right now. Notice how much you are paying for this contract right here. You're literally paying $19,000 to control 100 shares of Triple Q. But if you would just go buy these shares straight up, it would cost you $61,000, but you have no expiration date. No matter what the market does, you still have your shares forever at the end of the day. So why are you spending $19,000 hoping that the market goes literally to the moon because your break even is going to be $187 plus $480? Why on earth would you do this? Why on earth would you buy a deep in the money call option? I don't think it's worth it. I would just much rather spend this $19K, buy the shares, and they're going to compound forever. And if my timing happens to be, super bad and I bought right here, it doesn't matter because look at what it did from here to here. But if you bought a 2-year deep in the money call, that's 2 years of you making no money. You would have lost money on that contract quite a bit. I would just prefer, again, to just buy the shares. I don't like doing that stuff. So now you're probably like, well, Brandon, I don't want to buy, a call option deep into money. Let's just go buy a 650 call and let's just see how we land right here. If you buy a 650 call on the NASDAQ for 2 years out, you're paying $78 for that contract. So your break even is going to be roughly $715 or $725, my bad. Break even is roughly $725, we'll just say. But think about that. $725 is where you need the market to go at a minimum just to break even on those leap contracts. So does it make sense to do the leaps up here when the market's a little bit expensive and a little bit above the earnings per share growth line? No, but it makes sense to do those leaps down here. So when you understand where the market's at fundamentally, the macro, the micro, the economy, the labor market, all that good stuff, and you base all of your trades on the totality of all that data, it would be pretty obvious to buy 2-year call options down here. But I wouldn't want to go deep in the money call options down there because, again, look at how much I'm paying right now for these call contracts. I'm paying $8,000. But if we flip it similar to how it was before, like let's just pick a 450 strike price, like pretty deep in the money. You're paying all this money for this contract. You're paying $21,000, but you're still only controlling 100 shares. So if I'm going to swing for the home run, if I'm really confident on the trade, I would much rather not spend $21K on this trade. I would much rather just go like this and go just a little bit out of the money so you're not paying the in the money premium. And I could essentially control twice the amount of shares for the same amount of money. So I either like to go a little bit out of the money or I don't do call options at all. And if you want to go deep in the money, I usually think it's better to just buy the shares straight up. Because again, it's just like, why are you paying all this money for something that could literally expire worthless? I just don't think it really makes any sense. Okay, so to summarize very, very quick, when the market's cheap, I like to buy shares, buy call options, and sell put options. All longer duration options. When you buy longer duration call options, yes, you're going to pay a little bit more, but look at how much more time you have for earnings per share to go up and to the right. Those call options are way more likely to make money. It's way less gambling. This market just bounces around like crazy. It's all volatility in the short term. And again, selling put options. Longer duration's better because you could get a better strike price. You're getting more premium at a time that the market's cheap. You could go reinvest that because we're doing portfolio secured puts, not cash secured puts. So all of our money is invested when the market is cheap, which is what you want. And on top of that, because you're doing a longer duration contract, there is more demand for the longer duration contract because everyone's like, oh my God, what if the stock falls in 2 years? There's more demand for that contract. So you could get more premium, a better break-even price, and a much better strike price. That is the name of the game. Getting a strike price, like right here, the NASDAQ on the bottom right, $267 per share. If I were to go 2 years out, I could literally sell probably like a $220 put. Like look at the distance between where that strike price would be to where the earnings per share growth line's at. Like it is ultra compelling to sell that put. So that's what I keep trying to get through people's heads is that longer duration contracts win. It's easier, it's safer, you can get more margin of safety, you get a much better strike price, and you're going to be way more consistent with this in the long term. Okay, so I hope you got value from this video. If you want to watch the video going more into portfolio secured puts, I'm going to link that video right here. And with that being said, I will see you guys in the next one.